Well, it looks like President Joe Biden announcing another grant here and handing out some money for manufacturing batteries. Of course, this is the movement for the next generation. So we're going to see how that affects certain stocks today. Elon feels Tesla's valuation could exceed Apple and Saudi Aramco's combined 4.3 trillion market cap. Initial jobless claims coming today at 8:30 could shake things up. Philadelphia Fed Manufacturing Index, all state hurricane disasters. So many earnings stocks to go through. But the question now could be, could these earnings turn out to be not as bad as expected? Find out right here on Pre-Market Prep. Let's get it started. Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts, Joel Elkanin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day. Good morning, traders and investors. Let's bring on Dennis Dick and let's take a look at the overall market and what we're getting into today. It looks like kind of sideways action from the overnight. Not much going up, not much going down. But of course, we got a lot of earnings to get into. But what caught your attention yesterday, Dennis?
A lot of chop. Again, rallies just don't seem to hold. So we start to try to get that morning rally after the big sell-off. We had a pretty good sell-off in the pre-market, and then we rallied up to almost scratch. Actually, I think we got scratch. Then we sell it back off again, and then we rally up here, and then we sell off. And after hours, there's just been a whole lot of chop here. We've been down, then we were way up. Now we're kind of coming back in a little bit. So lots of chop, lots of moves to fade. It's been one of those markets here again where random walk theory is being proven correct, at least for these markets.
That it is. And President Joe Biden coming out and announcing a $2.8 billion in grants for 20 companies to produce batteries for electric vehicles in the United States. The funding will go towards the creation of battery grade materials, including lithium, graphite, and nickel. Of course, this is critically important, he stated, for the future of vehicles is electric. He also stated how 75% of battery manufacturing is done in China right now. So another area where we're battling with China. I don't know if that's a good thing.
I mean, this battles with China, and let's just go and look, at the China stocks, because holy cow, just when you think it can't get worse, Mitch, they keep going straight down. Like, this is telling you this whole, deglobalization we're talking about. China stock investing here right now is just been destroyed. I mean, some of the valuations are getting to be attractive, but you just don't know going forward, with all the political concerns here, potential, obviously, invasion of Taiwan still on the table. We don't know what's happening there. It's impossible to really, it's not to evaluate the risk. So if I can't evaluate the risk, it's hard for me to invest there. And if you look at FXI, whatever you want, look at these things, the double, you can look at the double one, but even the K-Web, obviously $20, you look at these things long-term, you think we've had a bear market here. Holy mackerel, nothing like in China. I mean, Alibaba is now $71 from over $300. Baidu was $350. It's $94. JD.com over $100. It's $41. I mean, these things have just been absolutely slaughtered. Anything over there in China, FXI, if you want to look at that too. I mean, we're at a multi-year low. You got to go way back, Mitch, like 2366. In 2016, we were 30. So go back 6 years, we're down like 25% from where we were 6, 7, 8 years ago. So, yeah, go out even further, Mitch, on the FXI, just for curiosity here. Your charts go farther than mine. How far can you go back there, buddy?
You can go back all the way until 2005. And then the spike in 2007 went to a high of 73.19.
Yeah, so since the financial crisis, we never came back on the FXI. We never came back. And this is China. Like, we're not just talking like, a stock. We're talking an index. So, I mean, and this is, the problem. The US markets have been riding the technology wave for so long. And that's really why the US market's been the best, performers. I've argued that before. Silicon Valley, we've just had so many innovative companies coming out, of Silicon Valley, really. This has been the driver. And now you're looking, you're just thinking, man, you keep thinking it was going to be a catch-up trade in the emerging markets, and it's worse. They just keep falling, and they're falling faster than our markets. So hard to invest overseas when you can't assess the geopolitical risk, you can't assess the possibility of a China invasion of Taiwan. You can't assess any of this. So we don't know. And then you've got obviously other issues too.
In England,
hard
also,
to be an investor over there.
We have problems also in England today. UK Prime Minister Liz Truss is in discussions with key members of the Conservative Party who oversee leadership challenges. And it looks like Liz Truss might be on the way out. And so more uncertainty, political unrest. I feel like the uncertainty out in Europe has definitely gone to another level. And I mean, another change in prime minister. They've changed the finance minister 4 times. It doesn't look like things are doing great there, especially in England.
Just so hard to assess the risk from everywhere, to your point. I mean, you think the US or you think North America's got it tough. It's a lot tougher everywhere else. Yeah. So European banks, we've talked about them before. They look like they're going into a full financial crisis here. So I don't know how all this settles out. But again, it makes it tough. I tried to buy a couple stocks in the long-term investment portfolio yesterday, just nibbling a little bit more, very small positions. But you come and you look and you think, man, is that a mistake to even be buying anything in this environment? I don't know. Tesla earnings, though, let's get to them, because actually the Tesla earnings I thought were fine. But the reaction to it, really not fine. Stock is trading down here, 12 more points. It's already in the gutter coming in. I would have actually thought with that report, give us the report, Mitch, then we can do the analysis. You might as well give us the report.
All right, let's go to here. Tesla's adjusted EPS at $1.05, beating the dollar estimate. Sales at 21.45, missing the 21.96 billion estimate. CEO Elon Musk said the company is not cutting production in any meaningful way, recession or not recession. We're very pedal to the metal, come rain or shine. The Fed's decision makes sense. And he's talking about interest rates here. If you're looking in the rear view mirror, but not if you're looking out the windshield, said Musk. He also stated that he was excited about the Twitter situation. So us Twitter fans out there, if you heard that comment on the call, and said that the company has a sort of languished for a long time, but has incredible potential. He was talking about Twitter. But then he also mentioned, I thought this was a little bit outrageous, but he did mention that Tesla's valuation could exceed that of Apple and Saudi Aramco's combined 4.3 trillion market cap. I think that was a little bit of a reach.
He was saying everything on the call, Mitch, literally like everything that he possibly could to really move the stock price higher. And he was really like trying to say everything and just throwing stuff out. He's probably ticked off that the stock was trading down. And it started ticking up. When he said that Apple Saudi Aramco stuff, the stock went from like 214 up to 218. And then just started leaking back and leaking back and leaking back as the markets was kind of saying, well, this is just Musk shooting his mouth off again, which obviously we know has always been the issue with Musk. Is he comes in and he's innovative, he does all that stuff, but it's always been what he says that is more concerning to the market than anything. I mean, just throwing out just random comments like this, not very really CEO like to me. More like a game to him, like, oh, I can be the best company in the world, I can be bigger than all of them, I can be bigger than the 2 biggest companies combined. It's just like going, you can just see how the slippery slope of how his brain's working there and then just spitting it out. So, I mean, but you can't argue with the innovation. At a certain point in time, like I've said, Tesla will be a buy because the efficiencies here are so much more than traditional automotive companies. The margins are so much greater. They don't have to advertise. You got Ford, GM, they're just advertising nonstop, trying to pump it out there. Tesla doesn't spend anything on advertising because its word of mouth is just so strong. So the brand is just awesome. Love Tesla. the company, the stock starting to come down. Like I was saying, I think it's trading like 42 or 43 times forward earnings, because it's come down so far. It's starting to become a little more reasonable. It's 60, 70, 80 times earnings. It starts to not, but forward earnings, it's starting to come, a little more reasonable. Get down to like 30 times earnings, starts to get forward earnings, starts to get interesting. Now, again, that's, saying that these projections are going to obviously come to fruition, which he's been pretty good though. Everybody said he couldn't do it, and he's made it happen. So love Tesla, the company, love Elon Musk, the innovator. I just get concerned with Elon Musk, when he starts to just shoot his mouth off. So I think that's what that was, the Apple Saudi Aramco comments, and I heard that. I was like cringe worthy to a certain extent. Doesn't sound very CEO-like, but it is what it is. Stock is down. Got huge support down here at 204. That is the low of the move. That is the low it absolutely needs to hold, because we always say when a stock's making new lows, you have to go. This is still holding its lows. That's a good thing. It's been basically cut in half from the all-time high of 414 back in November of 21, when everybody paid anything for anything and stupidity reigned. We've come back into reasonableness. It's not crazy on a valuation perspective. Like to get a little bit cheaper, but if you were nibbling in Tesla for the long-term account here, I won't argue with you. I'm not doing it yet, though. I think it might be early.
No, I'm kind of worried about it breaking through that 206 support.
Gotta hold that.
And breaking through. If it breaks through there, I'm honestly looking at an opportunity of it coming back to that original 5-to-1 split. If it could come back there, I would definitely be a buyer. So that's kind of maybe I have a bias towards that level, but just giving you the perspective of where I think Tesla could potentially go. And then that would be a big opportunity for me. But let's see if they go after the general today in Tesla. Of course, it could get taken out on the lower side. I did want to give some comments here from Gene Munster. He said that investors may shift from giving benefits of a doubt to a take and wait and see approach around the prospect of 50% compound growth and expanding margins. So this is what was stated. Of course, he said that we'd see more concern around Tesla's valuation over the course of the next 3 to 6 months. So that's from Gene Munster, one of our best analysts
and love Gene.
Tesla.
I mean, Gene does his homework, and I respect his opinion very much. And he thinks Tesla's going, and so obviously he's on the bull camp here too, and he's been on the bull camp for a while. So again, I'll just go back. I think Mitch's level, you got to hold the 200.
It's around 157 for the split level. They wanted to ask the chat, but yeah, right now the support, right? I mean, you're looking.
If it came back to 157, I'd be a buyer.
Yeah, I would too. 206.85 is that low right there that you'll be looking to see if we crack through today.
I'm on the, it's on my buy list, I will say that, but I'm not striking today. But it's on the watch list. It's come down enough that, been cut in half here now. It's a company that is going to be firing on all cylinders. I can say it's firing on all cylinders for a long time here. So I'm a fan. I just think we might be early.
I think so, early too. I am a fan. Next year, of course, 2 major products coming out. He did also talk about the semi-truck that will be delivering trucks to Pepsi. And so stay tuned for that in December. That could potentially give it some lift. I'll keep watch to see what happens in the situation. And of course, there was talk of the Cybertruck production, but we'll wait and see when we actually see the Cybertruck on the road. All right, getting out of Tesla, let's go ahead. Let's not wait. Let's get our guy on here. You guys might know him a little bit. His name is Marc Chaikin. You guys already know. Excited to talk to Marc Chaikin, founder of Chaikin Analytics. And I got some good questions for my man Marc today. How we doing, Marc?
I'm doing great. Giving you the Rocky salute, trying to push Philadelphia into the World Series.
Let's go.
Oh, there you go.
Oh, you think they make it? You think they make it, Marc?
I hope so.
All right, we'll be watching, that's for sure. Let's first talk about energy tickers. I remember, definitely let me know if I was correct. Did you bring up MPC last time?
Yes.
All
MPC
right, there you go. I've been
EQT.
keeping a watch on that one. What do you feel about the energy trading here?
Love it. I think that's the one place investors can put their money and not worry about whether 3,600 was a bottom or 3,500, I guess. But Energy is benefiting from so many different things. The Russian war in the Ukraine, OPEC price cuts, the European mandate to refill their storage on LNG up to 90%. And it's just a buy here. I think anybody who doesn't think energy's going to 100, 120 is missing the boat here.
Any other names?
Here's my concern, though, is that, and I bought some Oxy back in the end of September, and I was buying a couple oil stocks, but it's just the move now. I mean, ExxonMobil has just went from $85 to $105. Like the boat, sets sail. It's in the middle of the ocean. I mean, I hate jumping on this moving train. And I know, we're just breaking out here again. So as a short-term trader, the momentum is definitely to the upside. But I just look, we've had huge moves here in the XLE mark in the last month. I'm wondering if it's too far now.
Well, that's why I like the natural gas stocks here. Natural gas has come down from 968 per, what do they call that, MMBTU to 538. And if you look at EQT, which is my favorite stock and has been for quite a while.
There you go.
Like it.
If natural gas averages $5 over the next 5 years, they'll generate $22 billion in free cash flow. The current enterprise value of the company is only $21 billion. So if you think gas prices are going to stabilize where they are now, they don't even have to go up, this company's a buy. If gas prices average $7 over the next 5 years, this company, and this is management's suggestion, they'll generate $37 billion in free cash flow. So I think this is a long-term play. I know we've got a lot of traders on here, but everybody has a core portfolio. You do, Dennis.
Yes.
And I think this stock belongs in your core portfolio.
EQT is one play. You have some other ones too? Because I like this idea of natural gas because we're getting colder. Natural gas has been coming off and not rallying, and you just wonder if eventually it doesn't turn around. I kind of am in the same boat here. I'm a contrarian at heart too. You got any other natural gas plays? EQT?
SWN. It's a highly leveraged play. EQT has debt, $6 billion versus $15 billion in equity, but Southwest has a much more leveraged balance sheet, and they don't hedge as much. So SWN.
SWN, there you go.
Okay.
Got it. Oh, I like this one. Sure.
Yeah,
that's my kind of chart. That's my kind of chart,
it
Marc.
got a lot of sponsorship back in August when energy peaked, when gas peaked at 968. So these are two plays that one, I wouldn't call EQT a blue chip, but it is the largest natural gas producer in America. It has 6% of the American production. Interestingly, if EQT was a country, it would be the 12th largest natural gas producer in the world. So it's a serious player. I believe that after the elections, the Biden administration is going to junk the whole ESG debacle that we're in and say we've got to become energy independent again, which will help people like EQT. Because there'll be more drilling, and they've got great properties in the Marcellus Shale in Pennsylvania. They've just made an acquisition to extend their properties down into West Virginia. But I believe that it's hard to believe that we were energy independent, and now we're beholden to Russia and the Saudis. And the progressives would just boycott the polling booth if Biden announced something like this now. But you watch, starting November 9th, I believe, and I have no inside information, that any sensible government official is going to say, we've got to become energy independent again and start drilling and F the green huggers, the tree huggers. And I'm sympathetic for the environment, but we can't be beholden to the Russians, which is what's happening to Germany right now.
Interesting outlook there. It was actually going into my next question about what you would feel would take control of the narrative and drive this market higher and lower. You feel it's going to be more talk on going against ESG, more about bringing energy here?
Well, I think ramping up production in the U.S. We've got the reserves. This is crazy. It's like, you've got the goods, you're in a fight. As someone said, don't bring a knife to a gunfight. We're bringing a knife to a gunfight, and we've got the guns sitting there, and we're not using them. So that's just one man's opinion, but it just makes sense to me that at some point either the Democrats stay in control and wise up, or the Republicans wrest control. And if the Republicans wrest control, they're going to open the spigot on production and pipeline.
Still obvious. Go ahead, I was just going to change the subject, unless you had something to add to it, Mitch, because I was going to take it over to the war stocks. And Lockheed Martin was very interesting off of earnings. It was down initially, and then they just blasted it off. And, you look at General Dynamics and you look at NOC, and you want to see stocks with relative strength right now. I mean, the war stocks here are literally almost all at all-time highs. What are your thoughts here in this sector?
Well, I don't like buying all-time highs in a bear market. So
there's a point there.
That's my only concern. I'd rather buy them as they're testing double bottoms, which is just a few days ago. Is this a weekly or a daily?
This is a daily.
Yeah. I mean, they're we've been looking at a number of these stocks, Lockheed Martin, Northrop Grumman. They make sense, but they've made sense for 9 months. How long is the war in the Ukraine going on?
Yeah.
For 9 months, and yet, because we're in a bear market, there's pressure on these companies.
Yeah, I really haven't taken off.
Probably my favorite would be Raytheon, the new Raytheon.
Okay.
I think it's RTX.
Yeah, RTX. Interesting.
I see. I'd rather buy that, knowing that missiles are going to be in big demand, and they do make a lot of the missiles that get slung around.
It hasn't run as far either.
No.
So like Lockheed Martin really ran off the earnings. RTX is kind of sleepy here. Hasn't run nearly as far. I think, when people are thinking about the war, they think right away Lockheed Martin. That's the first one that grabs the bid, if you think it's escalating over there. And then obviously there's NOC, General Dynamics. I think RTX is, and even LHX, I think RTX is sometimes, an afterthought here. But I kind of like the chart here. I think you put a nice base at 80. I think on a pullback, you get back to 85 here. Not a bad looking chart.
Yeah, I agree. Let's talk about the market, guys.
Yeah, let's talk about it.
Big deal.
One question that I had for you, Marc, is that since this year has truly been I would say the real destruction to the classic 60-40 portfolio, in your opinion, should investors stick to that type of split in their portfolio, or is that kind of more of an outdated model for portfolios in this environment?
It's not only outdated, it's painfully dangerous for your financial health. I've been bearish on bonds for 2 years. So if you're bearish on bonds, 60-40 just is an anachronism. You've got to be in equities. If you're below retirement age, you have to be 100% in equities. And if you're retired and you're still working, and you're generating income to cover your expenses, then you still should be 100% in equities. So what's interesting to me in the fixed income area is that banks are now offering 1-year CDs at 4%. So think about that. They can borrow at 3%, and they're lending at 4%. Are they doing you a favor? No, because with inflation at 8%, you're going to lose 4% of your money.
Yeah.
But people are flocking to banks for CDs now.
And this is the problem, this is what obviously the problems with, some of these stocks, like I've talked about the utility stocks, I've talked about some of the others that, don't have the growth, but they've always had the yield, and people like the 4.5% and 5% dividends that these things get. All of a sudden, cash is competing with these stocks. And, all of a sudden, XLU, in the last month and a half has really gotten hit. And I mean, same thing with some of the staples. They've been hit as well. And I think, in the oils, you're getting different, stocks, for different reasons. But the main reason to own utility stocks is for the dividend.
Yep.
That dividend is not nearly as attractive when you're getting 4.5% risk-free assets.
Agreed. And if you want to, get the yield play, you can do it in energy, and ExxonMobil and Chevron get 3.5%. So you get the growth potential of the shortages that are, I think, going to be with us for the next 18 months. But you mentioned consumer staples, Dennis. That's a really interesting area because these stocks have wild PEs. Look at Colgate and Clorox. The PEs are in the 30s. It's insane.
Yeah.
I mean, how do you pay 30 times earnings for Colgate? Now, granted, an activist hedge fund has just announced a position in it, but look at the PE ratio. I think it's in the 30s.
Yeah, it's definitely.
So a lot of people see the dip here below the range. To me, that's bearish, not bullish. You've just made a 52-week low, and this is typically safe haven money. That's why I don't like safe havens. Never have.
Yeah, it seems like they haven't been working. What do you think about Procter's and Gamble's recent earnings?
Well, the earnings were good, but and they seem to be able to overcome cost push. But the chart tells you everything you need to know. This is not going anywhere, especially in a bear market, with rates, as Dennis pointed out, very competitive with dividend yields.
Yeah, if you're coming in stocks and you want to have stock risk here, I think you've got to find areas where you're actually getting, growth, and that's the whole problem with the staples, is that this is just conservative, no growth, stable cash flow. It does well during a recession. So that's the one argument. As we go into a recession, well, people are still going to have to buy their soaps and their shampoos, and they got to buy food. So all those staples tend to hold up a little bit better. But right now it's totally competing with cash.
Well, and also, if there were 12 times earnings, that'd be another story. But they're not. They're trading at a higher multiple than the S&P by a wide margin.
And here's an argument that, and I'm just going to take that argument and run with it for a second. I mean, this is the whole argument as why the S&P multiple needed to come down too. I mean, you assess it. If you put on your CFA hat and you look at valuing stocks from a traditional metric, the risk-free rate is a serious component in that. Yep. And when the risk-free rate is 0.5%. Stocks are worth a hell of a lot more than when the risk-free rate is 4.5%, because you just got to look at, discounting those cash flows, looking at it, what can you get? When you get nothing for your money, that's all of a sudden worth a lot. We keep saying, oh yeah, 20, 22 times earnings is historically pretty cheap, at least lately for the S&P. Well, it's not in a 4.5 to 5% environment. You take us back to the 80s, when interest rates were 15 or 16, I don't think we're going that way. Stocks were the last thing people were thinking about. So I'm not saying it's going to go there, but I'm saying you got to consider that risk-free rate when you're valuing these companies. And if you're going to come into stocks and have stock risk, at least give me growth.
Well, I agree with you. And there, I think that leads into my market view, which is that the Fed has basically told us, Jim Bullard yesterday and Kashkari 2 days ago, that the terminal rate for this cycle is going to be north of 5%. Which means there's at least 175 basis points to go, and that'll put the 10-year at 6%. And where does that put mortgage rates? That puts mortgage rates at 10%. If you've got the 10-year at 6%, mortgage rates are going to be between 9 and 10%.
Where does that put the consumer for discretionary income is my concern. If all of a sudden, and obviously, some people are on a fixed mortgage, with a lot of people, especially in Canada, variables, but those fixed mortgages come up when they got to renew them at a higher rate. Where does that put them for, spending on extra stuff? They're going to buy their food, they're going to have to buy their things, but that's, the concern is at a certain point in time, the consumer is just going to have less cash.
Well, I agree. And that, it starts with the housing market. Housing market really drives the economy. And the housing market is going to have a hard time with mortgage rates at 10% or 8, even 8%, which they're approaching. So, the Bank of America did a two-handed economist thing. They said, Moynihan said, we're very happy about the consumer. They're willing to spend. On the other hand, they set aside $500 million for loan losses. So, you can't have it both ways. Either the consumer is happy and flush, or the consumer is going to default on some of this credit card debt. And so this all leads me to think that we haven't made the bottom yet. That's where I was going with this. I think 3,200 is sort of my minimum target. And if you apply your sort of point of thinking, Dennis, if the S&P earnings are 200 or 210 in 23, which would be pretty flat, and you put a 15 multiple on that gives you 3,000 to 3,200. And, that's pretty much where I think we're going to be before this is over. It could happen quickly. Who knows what triggers it. That's my biggest concern in terms of trying to call a bottom, which is, a loser's game to begin with.
Yeah.
We haven't seen capitulation. And I've never seen a bear market end without capitulation. Even a V-shaped bottom like we had in March of 20, when it was a 23-day bear market or a 33-day bear market, you get capitulation. It's just bear markets don't end with a whimper; they end with a bang.
This is a much different market than 2022. Like there's a lot of people still saying, "Oh yeah, we'll V bottom out of here," but this is completely different. I mean, that was a sudden closure of the economy and then the reopen of the economy. I mean, it just kind of followed that, where this is completely different animal here. I mean, we're dealing with a sticky problem.
You got to find a chart of 1973-4, which I lived through. I was a branch manager of a brokerage firm in Philadelphia at that point, and had 40 brokers working for me, and they didn't even want to come in the morning. It was just brutal. Yeah. And I think that's the kind of patterns you got to look for. There were some very sharp rallies. The final drop in 74 was 34% from the last rally peak. So, and with all that, I'm still optimistic that a year from now, which unfortunately everybody agrees with me in the sentiment studies, a year from now, the market will be higher. The question is from what level?
There you go too.
Where do we bottom out? But that's why I like energy here, Dennis. And that's why I think you need to have some cash on the sidelines. But if you want market exposure, it should be in energy and healthcare, biotech, and some of the quality healthcare names like J&J, which got hit based on dollar headwinds yesterday. These are core portfolio holdings. One more name I'll give you, because it's in a different sector that's not strong, is Adobe. I think whereas Amazon has been a core holding for almost everybody who's a long-term investor, I think Amazon's had its day in the sun. I just don't think their business model in retail is going to hold up. Cloud may hold up, but Adobe is a stock I recommended a week and a half ago in my market letter. And my thesis was the new acquisition is bullish. The street thinks they're paying too much for it. In their investor day 2 days ago, their annual conference, they reaffirmed my thesis. They said, we see a 10-year growth path for the company. And I think Adobe is a quality name. Anybody uses Photoshop, and we all use PDFs.
Yeah.
And I think their SaaS model is brilliant. And if I'm building a core portfolio, I want some energy. I want a stock like Adobe in there.
I mean, it's a stock that's come from a PE of 55 or 60, and it's come down so far that it's come into like a reasonable valuation. I haven't looked at it lately, but I imagine it's in the high 20s, the PE here now, which doesn't seem crazy when you're still getting some growth here. And we could go back to GARP. You can start at the end of 2021, nothing made sense. Everything, valuations were all nuts, even on a GARP basis, but growth at a reasonable price. I mean, you kind of got it here with Adobe, and this is on my watch list too. And then just, sneaky, it was quiet there 2 days ago, but they reaffirmed their full year guidance there 2 days ago too, Marc. So nobody talked about it, but I like it when the companies are saying, hey, it's still going pretty good over here.
But I like to take the longer view. They talked about a 10-year runway that they see for growth, and they didn't have to say that. Nobody was putting a gun to their head. All people wanted to know is, are you going to meet your numbers? Because we're very short-term oriented. One other thing, if we have time to talk about, because I think it's really valuable for your listeners. There's been a couple of studies in the last 2 days on how big institutions are now using short-dated options. I mean, I'm talking 0 to 1 day expirations. They now constitute more than 50% of all options activity. And it's not the dates, it's not the mem traders out of Reddit and Wall Street Bets. These are big hedge funds and trading desks. And that's creating all this volatility. They're gaming the dealers in a big way, because they know how the dealers are going to react if they buy tens of thousands of short-dated calls or puts. And I think it's really bad for investors, because there's so much noise, and investors, when they see this kind of volatility, just sort of retreat to the sidelines, which in a bear market isn't the worst thing in the world. But I just wanted to point out, and you can find the stories on the internet, it's very disturbing to me that they've created these single-day expiration options, and big money has figured out how to game the system. And I think that's creating all this noise that are making people very uncertain about what's going on.
Mark, what about all these other ETFs, single stock ETFs now? I mean, when does it end? I mean, you got Tesla Q, TSLQ, which is the Tesla Bear Daily ETF that basically just moves the opposite of Tesla. So, I mean, these are just ways to get around the SEC rules, really. I mean, it's a way for, somebody to short the stock at Robinhood that can't, short stocks there. Well, they can buy TSLQ and get the equivalent of, Tesla. Are we going to come out with a bear ETF for every stock? Is this where it's going?
I hope not. I hope not. I mean, but you said the magic words. Anything that enables Robinhood investors is a bad thing. It's not a good thing. And it's like Cathie Wood coming out with a venture fund that locks you up for 5 years in private companies that she's going to make a huge fee on and you can't get out of.
Yeah.
That's not good for investors.
All right. Well, it seems like out there in the markets right now, everyone's watching Prime Minister Louise Truss. Looks like she's about to resign. So just pay attention out there. Just want to make that stated for traders out there. But Mark, great. Well, definitely, I want to have you on my live trading show, not necessarily for trading outlooks, but I want you to go over the Chaikin Money Flow indicator. And so I'm going to have to bring you on to that show. We got to talk about some money flow. I've actually been using it a little bit more and want to bring you on to talk about it. So I'm going to reach out to you, Mark.
Now you're talking. Next week, I will be talking to you from Boston, the Stansberry annual conference. We're part of Stansberry Research, which is part of MarketWise. So I'll catch you at 8:15 next week.
Have a good one, Mark. Appreciate you coming on like always. Take care.
Thanks, Mark.
All right, let's go ahead. Let's take a look at this market. How are we holding in right now?
Holy chop fest. So, I mean, we just actually were up, 25 handles, but you gave it all back. So, I mean, jobless claims come out, but now we get Liz Truss, the actual resignation here, and stocks are getting hit here now. I mean, you can go look at European stocks too, which are actually rallying on this. I mean, if you go over to the UK, they're rallying as well. I think the jobless claims really, chopped us up there. And if you want, we can grab that number that just came out at 8:30, Mitch.
Yeah, I got them both here for you. Initial jobless claims and Philadelphia Fed Manufacturing Index. Initial jobless claims came in at 214,000 versus the 230 estimate. And prior was, and I'm going to give you the prior reading. The prior reading was 28,000. So it doesn't seem like the initial jobless claims are going in the right direction. Of course, we've been looking for bad news in that so that we could start seeing the unemployment number rise, not what we're seeing here. And then you got also the Philadelphia Fed Manufacturing Index coming in at a negative 8.7 versus the negative 5.0 estimate. Prior was negative 9.9, so not moving in the right direction. They wanted to see it come in light towards, let's say, a negative 4.0. Not good there in the Philly Fed Manufacturing Index.
So we're up, we're down, we're left, we're right. All we can say is the chop continues. The Titanic bob, which we've been talking about, continues here. So, we don't have any more clarity on which direction this market is going. Nobody's got a crystal ball on this one. All I can say is chop. The way to play chop is to fade everything. And if you've been fading everything, buying it when we're down 30 handles last night, selling when we're up 25 handles last night, there's a lot of money being made day trading right now. The algos are killing it, but the long-term investors just got big question marks on everything.
Yeah, and it looks like more questions coming out of UK. I'm glad I kind of brought that up early in the day because I felt like today might have been that day that we saw the Prime Minister head towards the door. It looks like that's happened, and she's saying that the new Prime Minister will be named within about a week. So more uncertainty out in England. And that shows me really that the situation's probably worse than they're giving us, right? It's probably worse than they're letting out to the media if they're making changes like that and that quickly. Something I'd definitely be concerned about. We'll see what happens. I don't know, man. Going into today, I'm starting to feel bearish.
I'm just feeling choppy. So I'm just playing, not going to make, I think you just stay market neutral and you're fading all moves. Fading rallies, buying the dips, selling the rips, shorting the rips, buying the dips, fading everything. We could be in this 3-6, and nobody gives those possibilities, right? Everybody wants to give, these targets and these targets. Heck, we could be, if this earnings season gives wishy-washy too, where you get some companies warning, but other companies doing okay. We could be in this 355 to 375, SPY range here for quite a while. So
I think that would be a good thing. I would think that would be a good thing. Sideways consolidation.
Stabilization, probably. Yes. That's what Joel was calling for. That's what Joel's been hoping for. With some
I've been hoping for it too. 2-3 month sideways action would make me bullish, but I have yet to see that. Every month we get a little pop, but a lot of times we get the further drop after that pop. So we'll see what happens.
Trending down.
Yeah.
We've still been trending down overall. So let's go on to some other individual stories, and there's just a ton of them.
Any specific earnings on your
radar?
Let's
move away from earnings for a second. We had IBM, Lam Research, which the gains after hours were faded quickly there. But a quiet story that nobody's talking about here is Allstate, and it is getting absolutely hammered here this morning. And this is because it came out with damage estimates from and what they're going to have to pay from the hurricane down in Florida. So give us those details there, Mitch. There was multiple companies coming out with this stuff, but it doesn't look great for Allstate.
Yeah, it didn't seem that bad for Travelers yesterday, but let's talk about Allstate Corporation here today, announcing estimated results for the third quarter of 2022 of a net loss between $675 million and $725 million, and adjusted net loss estimated between $400 million and $450 million. Catastrophic loss for the third quarter net of reassurance are estimated at that $763 million, and that's pre-tax. So it seems like hurricane definitely having an effect here on Allstate Corporation.
This is such a hammering here for a stock that was very near all-time highs. I mean, you'd think people would be, a little bit more cognizant to buying these things up to all-time highs after we just had a hurricane, and all of a sudden it's like, oh, there's damage from the hurricane. We got to pay some money. What? This is the market that just
not a good thing for Allstate.
This is just the market that anticipates nothing. I mean, now they knocked 15 points off Allstate because now all of a sudden they're like, oh, you mean there was damage from the hurricane? I mean, the efficient market hypothesis on this stock could just be the example of how the efficient market hypothesis is so stupid. There's nothing efficient about this market. Who in the hell's buying this thing up near all-time highs when they haven't even come out with their losses yet? And then boom, the losses are bad, and bam, it gets hammered. So I mean, and you're down 11%. Is this overshooting? This is a one-time deal, so I tend to think so. But this is the market where the weak just get weaker, and now you broke all those momentum traders. You broke everybody who said this had relative strength. So in normal markets, I would say I'd probably buy this dip, but I'm just spooked in this market because everything just seems to go bloody lower. So GNRC to the example yesterday. I mean, you're buying that open, and it falls another $20 from where it opened yesterday. I mean, they absolutely hammer stocks when they're out of favor.
Yeah, we'll have to see what happens with that situation. Of course, it's not a fun situation to deal with damages and deal with insurances. I've dealt with it in the past in Florida. It's not a fun situation at all. All right, let's go towards a couple more we can get into. Let's do, I think, American Airlines. Let's go to AAL. As we've been seeing, it seems like the airlines are not showing that weakness. American Airlines coming in here. Let me get there. There's the banner for you. Q3 EPS at 69 cents, beating the 31 cent estimate. Sales at 13.5 billion, beating the 13.25 billion estimate. American Airlines says based on current trends, they see Q4 total revenue 11 to 13% higher versus 2019 on 5% to 7% lower capacity. And so what does that show us? They're getting more per seat, right? And they also see Q4 adjusted EPS at 50 cents to 70 cents on the high end. CEO Robert Ism said that demand remains strong, and it's clear that customers in the U.S. and other parts of the world continue to value air travel and the ability to reconnect post-pandemic.
Again, the airlines, and full disclosure, I do have a position on this, so I'll limit my comments to American Airlines. Like, I'll limit my comments to American Airlines. I'll just talk the sector overall. I mean, after the UAL, earnings, they seem to still be firing. They see the sector seems to still be doing well. I just wonder if that demand destruction isn't coming. We haven't seen it in a lot of sectors here yet, but I keep thinking they keep raising rates, inflation keeps being a problem. It's going to start showing up in different things. I mean, if you had a trip booked, 6 months ago, you're still going on that trip. But are you booking another one? Maybe you are. Maybe people are just going to find the money to spend. But I keep thinking the consumer's going to get strapped. I keep thinking that's going to show up in discretionary income and like discretionary expenditures. I just keep thinking that people aren't going to be going as many trips if they don't have as much money. But I've been wrong so far because obviously, the airlines are still doing pretty well. But I'm just cautious buying these stocks up into the strength that the worst may be still ahead of them.
It could be. It's all about that concern of recession, right? Either we've gone through it or we're going to it. And if we're going to it, there's still worries about the consumer.
Great point.
And I want to just quickly iterate, Alaska Airlines also beat. They had an EPS of $2.53 and beating the estimate of $2.40, sales of $2.83 billion, beating the $2.82 billion estimate. So it just shows you more that the airlines overall are doing well right now. Let's go to LVS, Las Vegas Sands, as they also reported today. And I don't feel like this is one of those companies that I couldn't see myself investing in it. Probably even if you bought the shares for me, but hey, let's talk about it. Las Vegas Sands adjusted EPS at a loss of 27 cents, missing the loss of 24-cent estimate. Sales at 1.0 billion, beating the 992.41 million estimate.
Multi-year lows these stocks are really at. I mean, it's 35 and the low of the move was 28. But when you go out and you look at the monthly charts, I mean, these things are still kicking around where they were in 20s. They're below where they were in 2016 and Las Vegas Sands. Win is right where it was in 2016 at 50. I mean, they had the run to $200 and obviously, it's come right back down. So you think, well, eventually it cycles and eventually they're going to come out of this. If we don't go into a recession, these things are going to look like steals at these prices. But if we go into a deep recession, if the consumer stays, a little bit strapped for cash, it's going to be less trips to casinos. It's going to be less money for them. So, I mean, again, right to your last question, and that's the question for a lot of these stocks overall. Are we going into a recession or are we coming through the recession now? I still think, to your point, I still think it's coming. So I still think we're going to be a heavy one because I just can't add up the math to raise rates like this and not put us into a recession. And I think the Fed wants us into a recession. So that's why if I'm buying these stocks, I'm saying we're coming through it now, and maybe it hasn't even started.
Let's go to Alcoa here and keep it going. Alcoa Q3 EPS coming in here at a loss of 33 cents, missing the 13-cent estimate. Sales at 2.85 billion, missing the 2.94 billion estimate. Alcoa's 22 outlook. Company expects total aluminum segment shipments to remain unchanged from the prior projection, ranging between 2.5 and 2.6 million metric tons in 2022.
Oh gosh, what a mess this stock has been since everybody had to own it. And if we just go back to January and February, the stock got up to $98, and now it's given it all back and then some. Now we're down here at 34. At a certain point in time. But again, if you're going into a recession, there's less aluminum demand. So, I mean, could this thing go full circle and come back to 20 from where it came from originally? It is possible. We saw some stocks do that already. So I don't want to be early. And we're not in this booming, everybody's building everything type of environment here anymore. So I got to think aluminum demand, steel demand, I got to think that is still coming down. So, and again, if I'm saying, it's a recession that we are potentially going to go into, if we're not in it already, it's not a recession. It's not one of those stocks you want to own during a recession. So down 9%, it looks cheap. It could bounce because it's oversold, but it would be nothing more than a bounce, I think. So you got to hold those lows in the move, 33.55. That's the low of the move. That's where it's got to hold if you're bullish. Well,
it looks like Starboard's at it again. I just saw it hit the tape.
Oh gosh, what's Starboard doing now?
VRT. They're going for Verti Holdings. And it looks like the shares are up 7% following a Bloomberg report suggesting that Starboard Value has taken a stake in the company. VRT is the ticker. I don't know this one, so I just
I don't know the company
plainly
either.
see that. The only thing I would say is purely technical. Look to the left, see if you can get back through that 15. But it's first going to have to get through kind of these levels over here. You can see kind of like you've been uptrending through it. Needs to get up through that high over here around 1350s. Could be in play today, but I don't know anything about this company, so I'd have to do my research just like I would suggest for you guys.
Amazing starboard, obviously. Elliott, all these activists. It's got to be nice to just be able to accumulate a position, then disclose and watch the stock pop 7-10%. It's like they're up.
That must be so nice.
It's got to be like they're up 7 to 10%. Immediately when they buy it. Buffett's the same thing, really. It doesn't pop sometimes. Well, some of them do pop 5, 6, 7% for Buffett too. I mean, that's the advantage of being these guys and having the respect in the industry that they do, that, you know, investors are going to chase what they're buying. So investors are going to chase, they buy something, they're immediately up 5 to 7% just because of who they are. So now, you know, boom, they get, you know, they bought the stock and now boom, it gets this. And we know they tend to hold up well. I mean, you can go back to Elliott and Pinterest. You know, it's held up fairly well since Elliott's taken that stake. So it's tough to fight the activists, but at the same time, it's hard to chase them too, because, you know, they didn't buy this thing at 12.27. They bought this thing probably at 11 or 11.50, and now you're already, you know, boom, you know, they're giving you, you know, you're paying up 7-8% from where they bought it. It's like the people who chase Buffett. I mean, yeah, it gets disclosed, but it just popped 5-6% because Buffett disclosed. So you didn't get it where he got it. You got it where, you know, where everybody else is getting it after we know about it. So
it's almost like
chasing on these.
It's almost like they should tell us they're going to buy it and then have to wait a day or two till they actually take the position. That would seem fair to me. But
that would seem fair, but they're never going to do that because it's their whole edge. It's their whole bloody edge.
Yeah, because they give a case, right? And well, we'll see what happens with that. Looks like, Starboard has been going, not stopping. It seems like every day we're getting new news from Starboard. So they're definitely taking their shots. Next one that I wanted to get into, let's talk LRCX, of course. We talked about it for a second there. Lamb Research. This is a bigger company that I don't feel we talk about often, so I just want to make sure we cover it. And I think it's an important one because we're running into more and more concerns about the battle that's going on in China with the chips. Let's give their numbers here. Lamb Research EPS at $10.42, beating the $9.55 estimate. Sales at $5.07 billion, beating the $4.88 billion estimate. What do you feel about Lamb Research, Dennis?
Stock all over the place after the earnings. If we can show the after hours chart, Mitch, do you have after hours charts on these?
Yeah,
show that.
Yeah, right there.
We popped initially significantly on the earnings and then slowly leaked. And then look how far it went down. I mean, we got down like 315 and now we come all the way back. This is the example of what I'm talking about here. You know, if the stock's going up 5-6% or 3%, you're like, oh yeah, buy, this one's going, and it pulls it back. Then it goes down 3%. I got to get out, sell, and then, you know, it comes back the other way. Fading the moves. This is your classic, you know, just earnings where they're, you know, they appear to be okay at first, and then, you know, for whatever reason, they find a reason to sell them, which is what they seem to do. But just fading moves is working so well in 2022. You know, everybody still wants to buy the strong and sell the weak and play the momentum and all that. And that works to a certain extent, but, you know, even it's been, you know, not working either because they turn so quickly. I mean, you know, you go back to Alcoa in August, it looks like, yeah, it's breaking out, it's looking good. And then they pull the rug out from under it. 2022 has been the year of the contrarian. The contrarian traders are winning. The momentum traders are not doing as well in 2022. And you've got to adjust your trading strategies for your market environment. So I'm going to keep saying it. Fading moves in 2022 has been the way to make money, not chasing moves.
You want to know, I think this was the comment that scared in the earnings call a little bit later after the report, was that they released this on their earnings call that they expect a $2 billion to $2.5 billion revenue impact in 23 from the U.S. exports restriction to China. This is what I've been trying to kind of wave a little bit of a red flag to. I'm not saying that this is going to affect all these semiconductor equipment stocks as much, but I think this is a red flag for the industry overall. And I'm just trying to put it into the perspective out there so you guys can do the research. And I think this is going to affect the whole industry overall in semiconductors. We'll see what happens.
Can we talk GNRC?
Yeah, let's do it.
Just the follow through from yesterday, and we mentioned
Continue
it briefly
down
here, but this is absolutely nothing short of an incredible fall from grace. I mean, here's a stock that was $524 1 year ago on November the 5th, making new all-time highs. And we were in the booming economy and everything looked just great. But we were warned back then. We knew inflation was sticking. We knew the Fed was going to go into a tightening cycle in 2022. And that was just the key to sell all, everything. But GNRC is right at the top of the pecking order. And I said this yesterday. This is the last thing you buy when you're starting to get strapped for cash. I mean, it's so much, nothing has impacted more than a stock like this. And the simple reason is that this is obviously directly related to home builders because new homes getting generators. So it's related to that. As rates go up, there's going to be less action on new homes for sure because people can afford less or people can't afford to buy that home that they were going to buy, or people can't afford to obviously, build that home that they were going to build. So, I mean, this has just been hammered. It's a housing play, GNRC. It has been absolutely ugly. I know people are looking at this and saying, well, this is coming back eventually. And I agree. I think it will come back eventually here, but the valuation got crazy. Valuation may be reasonable here now, but right now this is like your recession stock that gets hit the hardest. This trend is broken. Everybody who keeps trying to buy the dip keeps getting hurt. Maybe it's capitulation, but then you get overnight, you get the analysts chasing price. They're all downgrading the thing now. At a certain point in time, GNRC is going to be a buy. This isn't a zero. It's not like GNRC is going out of business, but you've got to just be careful. I don't think there's any reason to be a hero, catch the falling knife and say this is the bottom, because everybody's been trying to do that for the last 6 months and it just keeps going lower.
Yeah, this is one of those companies that I just feel like, do they truly have a competitive advantage?
Well, they do. They do for sure.
What
Generac is the generators, they have a competitive advantage. So if you want a generator, I just don't think there's any demand for generators.
But there's other generators, right? There's Honda, there's Tesla.
Not like Generac though. They're like the name. Yeah, okay. Mitch, it really is. I mean, their generators are awesome. So I think, it's not, I think they do have a competitive advantage. So I wouldn't argue that. I just think it's the market environment they're in that makes this thing scary to buy right now. But at a certain point in time, it's going to be a buy because of that competitive advantage. So, if you're buying this at 105, you're going to be happy 5 years from now. I tend to think so, but I'm not sure, and we're never certain. So I would be more inclined to wait until at least, if you've come this far, it's not going to test $100. I mean, everything likes to test $100. When stocks go from one, to the Kenny Glick theory, Kenny hasn't been on for a while, but it's got some, some serious weight. Stocks that go from 10, then they take out the 10, then they start looking at 750, then start looking at the 5. I mean, stock go from 150 to 105. I think very rarely aren't going to go to 100. So I would think you're probably going to get a shot at 100. Now, does it, hit the stops at 100, bottom at 98? That's a possibility, but I think buying at 105, I think you're minimum 5% early, which is just my opinion.
Yeah, I don't know what to say about this one. I wouldn't step in front of it at all, but I mean, to each his own if you want to try to get it on the low. We'll see what happens there in Generac. Let's give another earnings report here. We can go to AT&T, a Dennis favorite.
I love AT&T. All rallies to be sold in AT&T eternally. I don't care what the earnings go. This is just my opinion. I have been bearish this stock for 5 years.
I have been
absolutely correct. Joel's fought me on this, saying, oh, the dividend's pretty good. I mean, yeah, and then they cut it in half, and now it's fallen so far that the dividend's back to where it was looking pretty good again at 6.91%. Stop looking at the dividends, start looking at the company. This company is being attacked on all sides. DirecTV is an absolute mess. Cord cutting is an issue here. You're going to have more compete even in their mobile. So I just think AT&T is under attack all over the place here. Absolutely hate the stock, hate the company. I'd be a seller of all rallies in AT&T. Is it oversold? For sure it's oversold. This is not, and is it going to get bought here today? It was a pretty decent report. Yeah, it looks like it's getting bought. Is it going to reverse at some point in time? I think so, because that's just what seems to happen in AT&T. I don't want to own any of these things. Jason Raznick was right on Verizon too. I was right as well, agreeing with him. We said we'd be selling that thing at 55. It's $36 here now. AT&T and Verizon absolutely hate the stories.
Ooh, that Verizon chart.
I think AT&T could. I think AT&T could eventually be under $10. Sorry, you get your dividend.
I'll at least give you the earnings here, and there was some positive in their earnings. I will say that
it was a decent report.
They did get net additions coming in at 7.13 million, easily beating the forecast of 4.7. So it seems like they're getting some additions. EPS beat at 68 cents, beating the 61 cent estimate. Sales beat also at 30 billion, beating the 29.86 billion estimate. They expect to reach wireless service revenue growth in the upper end of 4.5% to 5%. And expect to reach more than 130 million 5G mid-band pops by the end of the year. Seems like it wasn't the worst earnings report. The one thing that I would give on AT&T is this kind of monthly level. This monthly level around, let's say, 15.15 is an important level to watch. I think you're going to get a nice bounce off this. I actually might be looking at this to trade this kind of intraday, but I just feel like this is kind of more of a stock that I would rent versus own.
Stop buying stocks for dividends. In rising interest rate environments, dividend stocks suck. This is the bottom line. Say it. Dividend stocks suck in a rising interest rate environment. So we got to stop buying stocks for dividends. If you're coming to this environment, at minimum, you want some growth, or at least you want like an energy story or something like that. But coming in and buying stocks saying, oh, I like the 6.9% dividend. You get 4.5% in cash. You can pay 2% for a business that's under attack to pick up 2%. It's nothing sound like a good risk reward perspective to me. So could AT&T eventually come back? Maybe, but they got to change everything that they're doing.
All right, wrap up for the day. What are you thinking on the action in the pre-market leading you to the bell? Dennis, what are you seeing out there?
Chop, 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 chop. Don't chase. We're going to be up. We're going to be down. We're going to be left. We're going to be right. Fade everything until further notice. That is my opinion.
We will have to wait and see. The market will tell us. Appreciate you like always, Dennis. You have a great day, and we'll see you tomorrow. Oh, well, actually, we will not see you tomorrow, my friend.
No, I am off.
Let everybody know you are off tomorrow.
I am.
Look, I didn't kick out Dennis and Joel tomorrow. They chose to take the day off. Don't get mad at me. Don't kill the messenger tomorrow. Dennis will be taking his probably one day off of the year,
Yeah, I don't take a lot of days off. So I am taking a day off, my anniversary weekend here, going away for the long weekend there. So my wife can never get me away for a week, so she'll get me away for a day.
Hey, well, she deserves it. So she deserves some Dennis time also. So we can borrow you for a little bit. We can lend you out. Don't worry, Dennis.
All right, lend me out.
Definitely be wishing you back. So have a good one, my friend, and enjoy your trip.
Okay, thanks, Mitch.
All right, I'm going to start wrapping up the day here. You guys can come over now to live trading action. Come over. Come check out. I might be trading AT&T. Might be trading SWN that Marc Chaikin mentioned earlier on the show. So if you missed Marc Chaikin, definitely hit the rewind. Check out that interview. We had a great show today. Talked about a lot of different areas. Prime Minister Louise Truss, of course, resigning during the show. At least we brought it up really early so that you guys were aware that this potentially could be happening today. Now it's your turn to go do the work. Like always, the one thing that we can do is point to the headlines, point to the areas, give you perspective. But like always, it's time to do the execution, and that's where you guys go ahead and play the trading game. We'll see what happens today. Go ahead and do what you know best. Work on those skills to improve, and I will see you tomorrow on Pre-Market Prep. Going to have a special co-host or something to kind of talk about it. But I won't leave you, team. I won't leave you down so that you guys don't have Pre-Market Prep tomorrow. I will do my best to try to fill in and give my perspective a little bit more tomorrow. Dennis and Joel out, but I will see you on live trading coming up next. And of course, later in the day, we got Benzinga Live, stock market movers. Don't miss it. Today, we also will be having the roadmap. And if you guys want to check out, if you guys have heard about So Rare NFTs, I'm actually going to be doing some fantasy basketball with NFT action with Chris Ketchy on the roadmap today, 2 p.m. Eastern. Don't miss that. I will see you guys on live trading. It's time to do what we do best and go get it. Go get that money. I'll see you guys next time. Traders and investors, pre-market prep, and hit the like on your way out.